Hey, good afternoon. This is Ralph Minnis, and we're going to talk about Chapter 19. The so in the first one, they want you to compute under absorption costing, and in number two, they want you to compare under variable costing. So let's back up and talk about what this is. Let me go back here. So in your book, we're introducing variable costing and absorption costing. So variable costing is where direct materials, same as absorption, direct labor, same as absorption, and variable overhead are included in the product cost. And down here for absorption, it's all costs. Variable and fixed overhead costs are included. And this method is required for external financial report under GAAP. Variable costing is not required under GAAP. And then let's just look here at this example so we can go back and we'll do a couple of problems. Absorption, GAAP, external reporting, variable for management. Look at the product cost, materials, labor, overhead. Product for variable, for product, but the overhead down here becomes a period expense, whereas over here you have to include it in the product. So let's go try a couple of problems. So under absorption, we have to include all of them, all the expenses here. So let's see here. So I have materials, labor, overhead, plus though the overhead is 246,400 divided by 28,000 units is 880 plus the 1080 plus the 2080 plus the 1080. So I'm going to say it's 5120. So I added materials, labor, and overhead plus my fixed overhead because absorption includes all the cost. All right. Let's try the next one. Oh, just the variable. Just a variable. So we don't have to include the fixed overhead, just materials, labor, and overhead. Materials, labor, overhead, 30, 40, 50, 51, 20. Let's see. 20, 30, 40, I'm sorry. 20, 30, 40, 41, 20. So my math error in my head. 41, 20, and that should be right. So let's see. And if I go back to here, was it 10? So a little bit different. I can't really say. But anyway, so there you understood which ones you include. Now let's go try number 3. Computing unit and inventory costs under absorption. So materials, labor, variable overhead, and fixed overhead per unit. So let's see what we're going to do. 13, and here we're going to do 18, and the variable over is 2. Well, what about the fixed? It's 90,000 divided by 22.5. That's how many units you produced. So I'm going to say $4, and that's the cost per unit, 37. Now, it wants to know, determine the cost of the ending finished goods. You got 6,000 left. So I'm going to say 6,000 times, let's just do the math, 6,000 times the 37 is equal to 222. So they multiplied 6,000 times that. Now, what about the cost of the units sold? Cost units sold is 22,000. Oh, 16.5 is sold. So I'm going to put 16.5 here. And 16.5 times my 37 is equal to my 610. Let's check my work. All right. So here, again, it's under absorption, and absorption uses the fixed cost. Now the variable does not. We're going to go here to variable, and variable does not include that one. So let's go back now. What's number 4? So they want the same thing except now per variable. So materials, labor, and variable overhead. So 650, the 750, and the 250. So there's what we have. For finished goods, I got 9,400. And how many units are sold? 28.5. So we did not include, we only have included materials, labor, overhead for variable. So let's check our work. So there we go. That's number 4. Now, let's look at number 5. An income statement, a variable costing income statement. Well, this is going to have sales, and we're going to have variable production, and then we're going to have variable selling. Do we have anything else? No, that's it. So there's, we should have it. And this should be our, and this should be our contribution margin. And then down here under variable, we should have our fixed sales minus variable cost equals contribution margin. Where's our fixed cost? Less our fixed expenses, which are fixed overhead and our fixed selling and admin. And that's equal to net income. So your variable up here, you're fixed. So let's go back to the text and just see if I can find this. Materials, labor, overhead. So here's an example where the overhead is included in absorption, the fixed, but not in the variable costing. All right, let's go to the next page. There's the income statement under variable. See how the variable expenses, variable production, variable selling, and the fixed go down below. Fixed overhead, fixed selling, and admin. Now, in this case, they're showing you absorption and variable are the exact same net income when the units produced equals the units sold. You produced 60,000, you sold 60,000, the results are going to be the same. But other than that, they're not going to, if anything different, they're not going to be the same. All right. Okay, so let's see the next page. So here we have absorption. It's not sales minus variable cost. It's sales minus the cost of the goods. And then down here, you put your selling and admin, variable and fixed. So it's variable selling and fixed selling. So your formula is different for absorption costing. And here's variable. Sales minus variable production, variable selling, and the fixed are down below. So let's go back here. So it looks good to me. A manufactured tennis rackets, it sold 5,400 times how much they sell them for, 95. So there we got 513,000. What's our variable production? We sold 5,400 times 25.5 is 137.7. And variable selling are 250 times the 5,400 you sold. So there's that. What's our contribution margin? Oh, should I put it on the wrong line? Total variable cost. So 37, 40, 50. So 513 minus 151,200 equals a contribution margin of 361,800. And then I got to find my fixed. My fixed overhead are 87 and my fixed selling admin are 65.7. That's 153, and 361 minus 153, 450 is equal to 208, 350. So absorption, well, they're saying something's not complete. So what did I miss? Oh, well, maybe it's all the homeworks. I'm not sure. So anyway, variable up here for variable costing, fixed down below. And it's not cost of goods, it's equals gross profit. It's variable expenses equals contribution margin. And the contribution margin is what's contributing to pay your expenses. So if we know we sell pizza for 15 and they cost us 5, contribution margin is 15 minus 5 is $10, and that is what we used to pay our fixed. The other thing that's useful in that example I gave you, 15 minus 5 equals 10. 10 over 15, what's the fraction? 10 divided by 15. We know we have a 66% contribution margin. So that helps us in our analysis. All right, let's go see what they want now. Oh, well, now they want absorption costing. Well, they use the same thing. So they use the same 5,300. No, it's not. It's the numbers are different. So on this one, it was 4,200 sold. So let's see the sales. And then 4,200 times 83, 348,600. Now, what do we subtract? Less our cost of goods sold. And then this is equal to our gross profit. So there's a difference. But what expenses go up here? What goes here? Do we put fixed overhead? Yep. And what else? Variable overhead. So do we, what's our fixed overhead? 65,190. 65,190 divided by how many we produced, 5,300 times the 4,200 we sold. So does everybody understand why it's not the full amount there? It's based on what you sold. Now let's take our variable overhead, 24.30 times 4,200 sold, 102,060. And then down there's our gross margin. So this is our, I'm sorry, what is this? Cost of goods. And cost of goods is comprised of fixed overhead and variable overhead. And now you're going to take the sales, 348,600 minus 194,880. And what goes down here? Our selling. But what's selling? Fixed selling and variable selling. And you know, if you're not sure what fixed selling is, like you have to pay like your salesman a base salary, and then commission above that. So there's the fixed salaries fixed, and this is their commission above that. And down here, this will be total. This will give me a total variance, total cost. Well, I thought it would be there, net income. So let's put the fixed selling. Fixed selling, 64.5. And what about here, the variable selling? The selling is $1.30 times 4,200 sold is 54.60. No, what did I mess up? 64.60. And these are my variable selling. All right, so let's see. Let's check our work. Well, what is it called then? Variable overhead, fixed overhead, fixed selling, variable overhead. Oh, variable production cost, variable production. Okay. And let's see how it got them. It took variable, oh yeah, there it is. Variable product cost. I used the wrong word, 2430. 2430 times the 4,200 sold. Yep. Okay. I used the wrong word. Check my work. So fixed overhead, variable production, fixed selling, variable selling. So that's the difference. And let's go on to the last one. There's only 7 problems in here. Absorption costing. So now it wants to do an absorption costing income statement. So 217 times how many did we sell? Produced and sold 21,000. So 21,000 times the sales price 217. Wow, is it that big a number? 21,000 times Sales price of 217. So I have sales of 4,557,000. Sales. And let's go here. Is one of absorption. Well, sales start off the same. Now over here, what is it going to be here? Less cost of goods, less cost of goods sold. And what is comprised of? We have materials, labor, and overhead. And that's going to be equal to, let's see, this is equal to our gross margin. Is it, let me, all right. So I'm sorry. So this is my total cost of goods if I add these up. So now $21 materials times 441. What was your labor? $29 times the 21,000, 609. And then the fixed overhead is 189. And variable overhead is $7 times the 21, 147. And that adds up to the 1,000,003, 4,557,000 minus 1,386,000 equals 3,171. All right. So now that's absorption, where include all costs. And down here, you have general, selling, administrative. What else do you have? Fixed, selling, administrative. And they have variable, selling, administrative. There you go. So let's see what they have. Do they have fixed selling? So they have a fixed 202. But they have a variable selling of 19 per unit. So 19 times the 21,000 equals 399 is 601 added together. And then the 3,171,000 minus the 601 equals the 2,570,000. I'm sorry. There you go. Now, the next one we're going to do is variable. Now, here's what I'd like to tell you. Before we start, when I saw this, units produced and sold, because of that, because the units, what we produced and what we sold are the same, we should get the same net income over here. So let's just try this. Net income. Let's try it here. Sales are that, less our variable cost. And here we have variable. Oh no, we got to put the other way. Materials, labor, and where's our variable overhead cost? Here we go. And then this is our total variable cost, or let's see, somewhere I got to get here, is equal to our contribution margin. Now, $441, and it should be the labor should be the same, 609. And do I have variable overhead? 147. And here we don't include the fixed. So down here you have to put the fixed expenses. And down here you got to put the selling. Where's the fixed selling? They have variable selling. Variable selling should go up here. Selling, and that was the 19. $399. And that should be there. And the 4,557,000 minus 1,596 equals 2,961,000 contribution margin. And my fixed expenses should be my fixed selling and my fixed overhead. What are my fixed overhead? 189. And the fixed selling and admin, 202. So 2,996 minus that 391 is 2,570,000, which should match the absorption because the units sold and produced are the same. So let's just check our work, see if we got it right. There it is, and there it is. So great job, and look, it was only 7 here. Now, we want to talk over one more thing, though. Why use this variable costing? It provides managers with the information necessary to provide a contribution margin income statement, which leads to more effective cost volume analysis. CVP, cost volume analysis. Conversely, absorption costing meets the requirements of GAAP, but is not useful for internal. So now, another benefit of using variable is production managers cannot manipulate income by producing more or fewer. Whereas under absorption, a production manager could increase income simply by producing more units than are currently needed. Now, what's the limitation of variable? It's more useful if a company wishes to compare different product lines, potential profits. You know, you got a couple of brands of cereal, you know, or which one's more profitable? You got different chairs and sofas, which one's more profitable? It is easier to discern the difference in profits from producing one item by looking solely at the variable cost. Now, a disadvantage of it is they feel like it's inaccurate cost. Directly identifiable fixed cost is specifically related to production. So in long-term pricing, variable costing is not useful for long-term pricing because it doesn't include no fixed factory overhead as part of the product. And you know that, you know, fixed overhead, you have to recover it. So that's the limitation. Now, absorption includes all the cost, while variable can exclude some direct fixed cost, okay? The net operating income of absorption systems is always higher than variable when inventory increases. All right, and then how about the last thing? Right here, in cost volume analysis, or CVP for short, we're looking at the effect of 3 variables on one, profit. CVP analysis estimates how much the change in a company's cost, the fixed cost, and the variable cost in the sales volumes and price will affect a company's profit. This is a powerful tool in management, finance, and accounting. It is one of the most widely used tools in managerial accounting to help managers make better decisions. Here's a step-by-step method. So operating income equals sales minus total variable cost minus total fixed cost. So now your operating income equals price times units sold minus the variable cost times the number sold minus the fixed. So gross margin and contribution margin are not the same. Gross margin, sales minus cost of goods, is not the same thing as sales minus variable cost. When we took the pizza, sales, $15, minus our cost of our cheese and our tomato sauce and the pie crust, $5 is 10. That does not include all those other fixed costs. Doesn't include the rent, doesn't include the insurance. Determining your contribution margin is simple as determining what percentage your contribution margin is your total sales. So in our pizza, 5 divided by 15 is 66. So this means for every $1 increase in sales, there will be a 60% increase in the contribution margin to cover your fixed costs. So why do we use? In analyzing CVP, a powerful function is to calculate the break-even point in units for your firm. You can do it in dollars by multiplying the sales price for your product by the break-even points in units. So CVP, one of the focuses is this is break-even, and that's why this is very useful. All right, I hope this helps you, and you'll have a wonderful day. And thank you very much. All right, God bless you all. Hope that helps you with chapter